Namaste, friends. Welcome to the next lecture, which takes us to a very different aspect of finance, and that is management accounting. As we know, that financial accounts are talking about the past. They are based upon certain assumptions, they are based upon certain ground rules. But still, they give very interesting information. And the first process of analyzing this past performance is popularly known as the ratio analysis. That you try to find out what has been the relation between your sales and your profit, how much have been your raw material cost as compared to your sales, what has been the return which the shareholders get out of the capital which they have contributed, what has been the cost of manpower as compared to your total sales, what has been the total debt as compared to the owned assets, what has been the relation between the debtors and the creditors. These are the type of analysis which can be done, which is called ratio analysis, but it has a limitation, and that is that it is based upon the past data of your own company. The moment you go little beyond from there, you will say that fine, I am going to make 5% profit on my sales. It based upon the assumption that you are talking from the past accounts of yours. The future is going to be different. Secondly, you would like to compare it with someone else in the industry, compare it with someone else in different country, and also see that if in the past year it was 5%, next year looks more buoyant, it's likely to be 7% or likely to be 8%. These are the type of analysis which are carried out once your financial accounts are prepared. Now, this will help in a different way also. You can analyze your past data to find out that what is the cost per unit, because ultimately you are not going to just go and say sales. You are going to say that my one product, my one mobile phone which I am manufacturing is going to cost you 10,000 rupees or 11,000 rupees. That number is fixed. Now you would like to know that how much it is going to cost you to manufacture that particular unit. A company might be manufacturing 15, 20, 30 types of mobile phones. Raw materials will be available from 5, 6, 7, 8 sources. Your factories will be located at different places where the rental income and the wages are different. So this creates a very complex and interesting combination which you have to appreciate and try to find out that for my company, how much would a particular brand of mobile going to cost me? Now this requires an exercise which is called an exercise of costing. That you would like to find out your per unit cost. Firstly, to start with, you look at your past 1 year's data and find out that how much did it actually cost. Now it's a simple thing to ask a question but difficult to answer. The reason is that you have got various costs which you have incurred. So one type of costs are called the direct costs. That say for instance you are talking about mobile, the cost of the chip, the cost of the plastic cover, the cost of the screen, they are direct costs. Directly you can identify with a particular mobile and work out that how much and you have your purchase invoices, so you can average them out and find that out. But another type of cost are the overhead costs. That is that these are the costs not for a particular design or a particular unit of your mobile. These are the common costs which are incurred across all your different types of mobiles. These are manufacturing costs. And you will have to find out some way of identifying that what is the load of manufacturing costs. Say I have got chips and everything laid down on my table. I'll have to have someone who is going to put it together, is going to use power. That person will have to be paid salary. Out of 10 units which he is trying to assemble, 2 units are not going to work properly because there might be a short circuit here and there, or some part might get broken. Keeping these things in mind, you will have to allocate, you'll have to distribute the common costs which you have incurred in order to manufacture the mobiles and arrive at a per unit cost. The overhead cost can be manufacturing overhead, can be marketing expense. You might have Shah Rukh Khan or someone else to advertise for your product. He is going to charge you money, and from where are you going to recover that money? You will have to sell it, and therefore in your selling price you will have to include this type of marketing cost as well. So look at all the cost and try to ensure that all the costs are distributed in a logical manner to the different products which you are manufacturing, and for a particular product 1 unit cost, and that will give you an idea of a total cost. This is extremely important for you to have a ballpark as to what should be the price which you should be able to sell it at. But then the price, people will say that it is what the market can bear. My cost might be 10,000 rupees, but the market is going to offer me only 8,000 rupees. So should I manufacture or not? Now this will take you to a process of decision making. Because at 8,000 rupees, I will not be able to cover all my costs. I will be able to cover only my raw material cost and perhaps the wages cost. So should I sell it at 8,000 rupees or should I not sell it at 8,000 rupees? So this decision is also a basic element of your costing for decision making. So in that case, now we have taken the illustration, let me go a little step forward. That what you should be doing is that whether I've got capacity to manufacture, right? And this is an additional order I'm getting for 8,000 rupees, and at 8,000 rupees a new market in Singapore is getting open for me. So I'll see I've got a capacity, people have got time to manufacture. If I manufacture this 8, what is my additional cost? What is my marginal cost? And I'll find out that additional chips will be required, additional plastic will be required. The same manpower is going to be used, and therefore I will not have to hire a new factory or have a new additional machines. Only my additional cost is going to be the raw material which is being used and some overhead like power, etc., which will have to be consumed, and that comes to 7,500 rupees. So this additional 500 rupees I'll be able to generate, and that is something which is profitable for me. Now this is one illustration of how costing data can be useful to you in taking decision. But basically, fundamentally, the costs are broken up for the purpose of decision making into 2 elements. One is the fixed cost and second are the variable costs. The variable costs are the ones which increase with the number of units which you produce, like raw material, like direct wages, the wages per unit which we are paying. These are your variable costs. The moment your production increases, this increases the same. Where the second are the fixed costs. No matter whether you produce or you don't produce, certain costs will have to be incurred, like rent will have to be paid. Administrative expenses will have to be incurred. Certain taxes will have to be paid. These are your fixed costs. The method of finding out that what is the level at which I should operate is that what is going to be per unit variable cost and what is going to be the per unit selling price. The difference between the two is something that is being contributed towards meeting my fixed cost. And if my number of unit increases, then with the increased number of units, my contribution will go up, and with an increase in the contribution, I will be able to cover my fixed cost. Now, this particular analysis is very, very critical, and which is being done day in and day out when you are evaluating various alternatives of the decisions. And it is in this that various jargons keep floating around. Someone will say there are certain type of costs which are sunk costs, some say relevant cost, some people will be talking about marginal cost, but the concept is very simple: variable cost, fixed cost. And in taking decision, in fact, if I use a local jargon, mera kya, in the sense that if I take the decision, what will be the effect on my bottom line? That is what you are trying to predict. You are going to look at the future implication of a particular decision on your ultimate profit and loss account. And for that, you will have to keep an eye on two things. Number one, in the past, what has been my experience? What is the cost? And in future, whether I'm seeing the increase in price, whether I'm seeing increase in fixed cost, and then looking at that, I am in a position to decide that how my future profit and loss account will be affected. I am presenting to you two very interesting charts. One chart is regarding break-even point, and that is the level of production at which your variable costs are fully covered and your fixed costs are also covered. In other words, your total sales realization will be able to meet all your costs, including overhead cost, right? That is the point at which it is breaking even. Means there is no profit, no loss. If you are able to sell more than that, there will be a better profit. And if you are not able to sell at that particular quantity level, there will be a loss. In other words, your contribution will be lesser than your fixed cost. This is coming clearly from the chart of the break-even. And second is the water pipeline illustration, which is also being shown. Here you have got variable costs. The selling price is coming into a pot. The excess of selling price over the variable cost is flowing into another tin. In that tin, you imagine that there are fixed costs. There are n number of products. So that contribution, that additional flow from all the n will come into the tin, which is represented by the fixed cost. And when all the fixed costs are also met, that means when the tin of the fixed cost is also filled up, there is something which is flowing out, and that outflow is your profit. So how do you increase your profit? You increase the number of n. So more product will be able to give. Number two, you increase the selling price. That means the more water will flow from the initial per unit tin to the tin of the fixed cost. You reduce your variable cost, means reduce the size of your product tin, and if you do that, then with the same selling price, more money will flow into the tin of the fixed cost. And this is the way you will be able to calculate, or you will be able to decide whether a particular level of operation is sufficient for you to make the profits. It is called profit planning. You have to wear the shoes of future, right? You have to get and visualize that how the effect of a particular decision is going to be on your finances and whether it is going to be beneficial for you or not. There are various decisions which people face day in and day out, whether to incur a particular advertisement expenditure or no. Now you find out that by incurring that expenditure, I am going to increase my fixed cost by say 100,000, and I will be able to sell 10,000 unit more, and that is going to give me a margin of 20 rupees. So I'll get 2 lakh of rupee. Compare the additional fixed cost and you compare the total additional sales revenue which you are going to get and decide whether it will be an advantageous proposal for me or not. This is also covered a little more in detail in the book which I have been referring to, and you will be able to, with illustration, you will be able to work out for yourself that how these principles actually apply in the real world. So this is the entire magic of costing. This is the base fundamental thing, how you plan your finances and how you take the appropriate decision, how you satisfy yourself with the decisions which you have taken in the past. And with this data, you can lay down certain standards for your company. And you compare your actual with your standard. Say, if things are good, this unit of my mobile, including overhead, should cost me 9,500 rupees. Then after 6 months, you look at your actual data and work out the total cost and compare and see what has been the difference. This is called variance analysis. And then go into further detail that what caused this variance, whether it is the increase in price or more wastage, what has been the reason why I could not manufacture that number of mobile or a particular mobile at a particular cost. This is variance analysis that you do, and out of all this analysis, you try to fix some target for future. The next year, I'm going to manufacture 10 lakh mobile, and on an average, if my realization is 8,000 rupees, I'm going to have 800 crores of turnover. That's called budgeting. And you budget for your sales, you budget for your manufacturing costs, you budget for your administrative costs, you budget for your finance cost, you budget for the basic minimum margin that you are supposed to, you're expecting, and compare the total budget with your total actual performance. That means that right from the bottom, from individual unit cost, you take the pyramid right up to the total unit, total business entity level, and you compare that with your actual performance and make sure that you are taking the right steps. You will have more details in the book, which I have been referring to, but this has been the concept behind costing, and understanding costing is something which is very, very essential and crucial. Thank you.